And I owe it all to Warren Buffett. And on the front it says, "This is that rarity, a useful book, Warren Buffett." And those few words sold a lot of copies.
So Howard, let's step back and talk for a moment about the most important thing. In that book, you listed a number of important things.
Yeah.
But Market Cycles is the only book you've written from that list.
Yes.
Why Market Cycles?
Well, I think that, the book says the most important thing. There are 21 chapters, and each one starts off by saying the most important thing is, and then it's a different thing. Because in investing, there is no one important thing. There is, maybe you might argue, there's no, what was it, Lombardi says, winning is not the...
Well, let's see how many people in the audience even know who Vince Lombardi is.
Vince Lombardi, anybody?
Okay, well, we have at least a third.
He said, winning is not everything, it's the only thing. And as I say in the book, I'm not exactly sure what that means. But I think that the two most important topics in investing are risk and cycles. And they're connected because where you are in the cycle determines your risk for the intermediate term. Now, the reason I think risk is so important is because I think that the distinguishing mark between a great investor and a not great investor is not merely how good the return was, but how much risk they took to get it. If you can lever up an S&P. Nowadays with derivatives or ETFs, you can buy an ETF that goes up or down 4 times as much as the S&P, or maybe 8 times. And if you buy that and you go into a very positive period in the market, you'll have an astronomical return, but it doesn't mean you're a great investor. Because they'll say, look at that guy, he went up 8 times as much as the S&P. Well, guess what? If it had been a down period, he would have gone down 8 times as much as the S&P. He added no value, who's not a good investor. I think that an exceptional investor is someone who has a good return disproportionate to the risk borne. A good return with the risk under control. So I actually do think that risk is the most important thing. And in the book, there are 21 chapters, and there are 3 on risk. Understanding risk, recognizing risk, and controlling risk. But I also think that where we are in the cycle is enormously influential in terms of how much risk you'll bear. And I'm not crazy about the title of this book. I was encouraged to do that by my publisher because they thought if we said Mastering the Market Cycle, we'll sell more books because everybody will figure out that they'll get rich. But I like the subtitle. And the subtitle is Getting the Odds on Your Side. We don't know what the future holds. I am not a believer in forecasts. In fact, Michael started off with a quote from Galbraith. My other favorite quote from Galbraith is that there are 2 kinds of forecasters, the ones who don't know and the ones who don't know they don't know. And I believe that very strongly, and I am firmly in the first camp. I don't know what the future is going to bring. And I don't think anybody does. The future can only be thought of intelligently as a probability distribution. What is the range of things that may happen, which is the most likely, which other ones are probable, and which ones are unlikely. And we describe, a great quote from Elroy Dimson at the London Business School, more risk means more things can happen than will happen. That's the source of risk, is that the future is uncertain. And if the future could be predicted, in theory, there would be no risk.
So let's step back, Howard, and try. So we're really talking about risk-adjusted returns.
Right.
And what Howard has said is, can you achieve returns with little to no risk? Right. And that's quite different from someone that's taking a lot of risk. And so as we think about the world we live in, there's been enormous movement today from active management of assets to ETFs or passive management of assets. But it's easy to understand what's occurred. What's occurred here is the market has gone up so significantly. And so if you're fully invested, i.e. in an ETF, by nature, you're 100% invested in whatever that asset category is, versus a money manager who might be 50% invested, 60%. So in an up market, it's very difficult to outperform a person that's fully invested. However, in a down market, which we really haven't seen in this growth of passive investment or ETFs, what is going to occur? Okay, obviously you're going to go down more because you're fully invested, not necessarily hedged, and you also run the risk of the issue of redemption. So we really haven't. So Howard and I are firm believers in fundamental analysis. Would you like to touch base at all on passive or
Sure.
investment versus fundamental investment? And obviously your background at Wharton and Chicago, we both lived during a period in academic life of this idea that the markets were perfect,
Yeah.
that no one could outperform the market. Our academic training, people won Nobel Prizes for it. They even won Nobel Prizes for telling you capital structure didn't matter, etc. So take us back to this debate, Howard.
Well, I was a Wharton undergraduate, and I learned the practical side of investing. And then I went off to the University of Chicago for my master's, and I learned the theoretical side. And the finance theory, the key theories, had just been developed almost entirely at Chicago in 63-4, that period, was when they emerged. And we learned things like Michael described, one of the most important of which is called the efficient market hypothesis. And what it says is that the market consists of a whole bunch of people who are highly motivated to get rich. They're all intelligent, they're all numerate, they're all hooked up by computer, they're all trying very hard. And their search for bargains has the effect of driving bargains out of existence. That if there are any cheap stocks, they find them, they buy them, their buying raises the price of the stock to full value. If there are any overpricings, they sell them, that brings the price down to the point where that's fair too. So all prices are fair. For the risk involved, QED, you cannot outperform the market. That's the official conclusion of the efficient market hypothesis. And by the way, they told us in Chicago, empirically, that the average mutual fund had not beaten the market, but charged high fees. Clearly, everybody collectively can't beat the market. So on average, all investors do average, but after high fees, all on average, do below average. And you shouldn't be in a mutual fund which is actively managed and has high fees. You should, and they said back when I was a kid, why not just buy one of every
Howard,
stock in the S&P?
are you suggesting we're both still not kids?
We're both still not kids, and we're still both not kids. But they said, why not just buy every stock in the S&P? Now, we didn't have a term for it, but about 5-6 years later, the term index fund emerged, and there started to be index funds. And if the average active investor does worse than the market, then it's better to be in an index fund which merely emulates the market. Index investing got off to a very slow start in mid-70s. Vanguard started the first serious index fund, Jack Bogle. And it still grew very slowly because you had to overcome the traditional resistance to turning things over to automatic processes. And, I wrote a memo. If you want to read on this subject, I wrote a memo in June entitled Investing Without People. And I talk about the historic development of index funds. And it quotes Ned Johnson of Fidelity. And he said, no American is going to settle for being below average. Now that is really, I have nothing against Ned, but it's a great example of, I think that statement has no introspection, or alternatively, maybe it's the statement of a salesman. Because of course you would settle for average if everything else you could do would make you below average. And for so many people would have been better off if they had average. Anyway, the point is that the highly priced active management in broad swaths, clearly not everyone, did so much worse than low-cost passive investing, that in the last 10 or 15 years, the movement to index investing and other passive forms, Mike mentioned ETFs, has gained a lot of traction. And now 37